As you save and invest for your retirement, the tax you will pay will naturally eat into your returns. The reduction in the capital gains tax allowance that's going to kick in from April 2023 is going to take an increasing toll over the next few years. So here are 6 ways you may be able to minimise the tax that you pay on your investments. Now, capital gains tax is payable on the profits that you make on investments outside an ISA and outside a pension. Broadly speaking, investment profits or gains are the difference between the value of an investment when you acquire it and what it's worth when you sell it. Everyone currently has a capital gains tax allowance of £12,300 each tax year, but this is reducing to £6,000 in April 2023 and then again to £3,000 in April 24. For most investment gains, such as the sale of stocks and shares, you pay 10% capital gains tax as a basic rate taxpayer or 20% as a higher or additional rate taxpayer. If your profits come from the sale of residential property, though, this is the residential property that you've invested in, not your own principal private residence, the rates rise to 18% and 28% respectively. So my first tip is to make full use of tax-free wrappers. Investments held inside an ISA or a pension are not liable to capital gains tax. So it's going to make sense to make use of your £20,000 annual ISA allowance. And of course, optimize your pension contributions. You can do venture capitalist trusts known as VCTs and enterprise investment schemes known as EISs. They're also exempt, but these are higher risk investments. So I really suggest that you seek advice from an authorized, experienced financial planner about those types of investments. My second tip is to offset your losses. Now, you can offset any capital gains losses you make against gains to stay within your allowance. So let's say you make a profit of £15,000 on one investment but lost £5,000 on another. Your £10,000 overall gain would still be inside the current allowance this year. This is the kind of planning that we do each and every tax year for our clients. Now, it's worth noting that whilst you cannot carry over your capital gains tax allowance from one year tax year to the next, you can carry forward losses. Thirdly, you consider splitting your sales across more than one tax year. So depending on your circumstances, if you know that your gains will exceed the tax-free allowance this year, then plan to sell some of your investments prior to the 5th of April and some after to take advantage of next year's tax allowances. The fourth tip is to transfer assets to your partner. Now, gifts between spouses and civil partners are currently tax-free. So if one of you is likely to exceed your allowance and the other has some allowance available, transferring the assets into their name before you sell them could maximize your combined allowances. My next tip is to consider something called bed and breakfasting. Now, it's a bit of a strange term for tax planning, but I've got a full video on that topic that you can click through to using the link on the screen now. In a nutshell, it involves selling some of your investments for a gain and then buying them back at hopefully a similar price. Now, this lets you use your capital gains tax allowance while raising the price at which you acquired the assets for future tax purposes. This is a legitimate tax planning technique that I use regularly with our clients every tax year end. The only catch is that you cannot buy back the same asset for 30 days. So you're either exposed to price fluctuations whilst being out of the stock market for that period of time. Or if you work with a financial advisor, then you can ask them to help mitigate that situation by buying maybe a similar asset for 30 days. The sixth and final tip is to make use of tax allowances and exemptions. You can deduct the cost of buying or selling assets from your profits before you're declaring them for tax. So that could include estate agents' fees or stockbroker fees, for example. There are fewer options for stocks and shares, but you might have some stockbroking commissions. Of course, you can give investments to charity without worrying about capital gains tax at all. Thanks for watching. I hope you've enjoyed this video. If you have, please press the like button now. And of course, subscribe so you never miss a video that I upload. My name's Justin King. I'm a chartered and certified financial planner. My aim is to help you live a successful life. And in my experience, that often involves understanding your money. I host a podcast called the Retirement Cafe Podcast. You might like to tune into that. And again, I'll put a link in the description below where you can find a link to the podcast. You can also sign up for my weekly newsletter. It's packed with inspiration and tips for a successful retirement. For now, I'm Justin King, helping you live your best life.